Hello and welcome to the Tax Lien Deed Core Concepts Training number 2. Now, in the last training, we talked about some of the basic information about the course and how it was structured, what you could do to get started. Now, with this training, we're going to begin by talking about property taxes. The next few trainings, we'll talk about some basics with tax liens and tax deeds. But to really understand the tax lien and tax deed systems, we have to go back to the root, which is property taxes, how they're collected, how they're enforced. And so to begin, we need to talk about the difference between federal laws and state laws. Now, this is familiar for many of us, but for some of us it may not be. The federal law, there are federal laws and state laws. The federal laws give the federal government the power to tax us. The state laws give the state government the power to tax us. The taxes that we deal with on a federal level are things like the federal income tax, the Social Security tax that we pay. On a state level, we pay things like a state income tax. We pay a sales tax if that's applicable in our state. But there's also a property tax. Now, that tax is contained in state law, but it's actually something that is delegated to individual counties or some of the smaller local governments to collect. So the power that the county has to collect a property tax comes from the state laws for that particular state. Therefore, every county within a set state is utilizing the same laws to collect property taxes. It also means that if you were to look at the state next door, that that state is operating on a completely different set of laws. That's part of the reason why tax liens and tax deeds can be confusing. It's because there are 50 different states, and each state has its own set of state laws, so there are literally 50 different ways that the laws are written. What we try to do with this is simplify that so that you can understand how all of the systems work, and they can all become easier to identify as you move from tax liens to tax deeds or as you move from state to state. Now, we pay property taxes for a number of different reasons. Many of the services that we see every day and that we utilize every day are services that are provided for by our local government. So the biggest expense would be public education. The public education is funded in large part by the local property taxes that are collected. It also includes things like the police and fire departments, the county buildings themselves. There are many different services that are provided for, and each one of those services require ongoing funding. So, for instance, with public education, police, fire departments, those are all different services that require funding on a consistent basis. Now, each one of those services are going to submit a budget every year. And that budget is essentially the amount of money that the county needs to be able to come up with in order to continue to provide those services. Now, if you own property, you're probably familiar with property tax bills. You probably received one in the mail before. I think it's important to understand what the property tax bill consists of and to understand how they come up with the numbers that are there. There are two different factors that will determine how much your property tax bill requires you to pay. Those two different factors are, number one, the assessed value of your property. It's done this way so that everybody pays their own fair share based on the value of their property. So the more valuable your property is, the more you pay. The other number is the property tax rate for the year. Now, this is a flat percentage rate that they multiply every property in the county by when they're coming up with the property tax amounts. So, for any given year, it can change. Typically, property tax rates will range from about 1 to 3%. You might sometimes find it a little bit cheaper, and in some places it might be a little bit more. So, for instance, in this example, if there was a 1% property tax rate for that year in the county and you had a home that was valued at $100,000 according to the county assessor, then you would pay $1,000 in taxes for that year. Now, the way they come up with that 1% is based on the amount of money that they need to collect, number one. So each one of those services that are provided for, they're going to submit a budget, and once the county comes up with a total amount of money that they need to collect, they can also determine what the total value is for all of the real estate within the county. So once they add up the total value for all of the real estate within the county, they can determine what percentage rate they need to be able to multiply that by in order to reach that budget. So literally they're relying on the property tax, the property owners to pay those taxes and to pay them on time so that they can continue to provide those services. What ends up happening is if they don't, it can create some problems, which we'll get into in property tax enforcement, which is the next part of the training that we'll get into, where we'll discuss how property taxes are enforced in different places, and that's really where the tax lien, tax deed systems, redemption deed systems come into play.